Ryan opens a 401k. Daniel opens a Roth IRA. They both think they made the obvious choice. They're both making a bet. Ryan just doesn't know he's gambling. And the thing he's betting on, tax rates staying low, has been wrong more times in American history than it's been right. Let's keep this fair. Ryan and Daniel are both 27 years old. Both earn $80,000 a year. The only difference is which account they choose. And hidden inside that choice is a bet neither of them fully understands they're making. Ryan enrolls in his company's 401k. His employer matches 50% of contributions up to 6% of his salary. Ryan feels like he figured something out. He tells his coworker at lunch that he's basically getting paid to save for retirement. Daniel opens a Roth IRA. No employer match, no tax deduction today. It stings a little more at the end of every month. Daniel doesn't. Daniel made a decision that most 27-year-olds never think through.
He decided he didn't want to make a bet on something he couldn't control. On every visible scoreboard in year one, Daniel is losing, and he made his choice anyway. Ryan just doesn't know he's gambling, and the thing he's betting on has been wrong more times than it's been right.
When you contribute to a 401k, here is what you are actually doing. You are telling the IRS, I will pay you later, not never. Later. You get a tax break today, your money grows tax deferred for decades, and when you pull it out in retirement, the government collects. Every dollar you withdraw gets taxed as ordinary income at whatever rate exists at that moment in a future nobody can predict. That is the bet. You are betting that your tax rate in retirement will be lower than your tax rate today. If you win that bet, the 401k was the right call. If you lose that bet, you deferred taxes into a more expensive environment and paid the price for it. Ryan has never thought about it this way. Most people haven't. When Daniel contributes to a Roth IRA, he is doing the opposite. He pays taxes today at a known rate. His money grows completely tax-free, and when he pulls it out in retirement, the government gets nothing. Zero. Whatever is in that account is entirely his. Daniel locked in today's tax rate and walked away from the table. Now here's the question that should make you uncomfortable. What do you actually know about the direction of tax rates in America? In 1950, the top federal income tax rate was 91%. In 1960, it was 91%. In 1970, it dropped to 70%. In 1980, still 70%. Reagan cut it to 50% in 1981, then to 28% by 1988. Today, the top rate is 37%.
We are living in one of the lowest tax rate environments in modern American history, and the United States currently carries over $36 trillion in national debt. That number grows every single day. The Congressional Budget Office projects that without major policy changes, federal debt will reach 166% of GDP by 2054. Interest payments alone on that debt are now the single largest line item in the federal budget, larger than defense, larger than Medicare, larger than Social Security. There are only three ways a government can deal with a debt that large: cut spending dramatically, print money and inflate it away, raise taxes. History suggests the third option is the one that actually happens. When Ryan contributes to his 401k, he is placing the bet that policymakers will choose option 1 or option 2 before they choose option 3. Daniel already closed his
tax bill is paid. Whatever happens in Washington between now and 2055 doesn't touch his Roth IRA. But let's not get ahead of ourselves, because in year one, Ryan still looks like the clear winner, and for a good reason. Ryan's 401k gets $700 a month, $500 from him and $200 from his employer. That's $8,400 going into his account annually. His take-home pay is higher than Daniel's because his contributions reduce his taxable income. At 7% average annual returns, Ryan ends year one with roughly $8,750. Daniel's Roth IRA gets $500 a month, $6,000 a year. No match, no tax break. At 7% average annual returns, Daniel ends year one with roughly $6,250. Ryan is ahead by $2,500 from day one, almost entirely because of the employer match.
By year 5, Ryan's 401k sits at approximately $49,000. Daniel's Roth IRA sits at approximately $35,000. Ryan is ahead by $14,000 on paper. His coworkers still ask him for investing tips. But here's what the balance comparison hides. Ryan's $49,000 has a number attached to it that doesn't appear on his statement: his tax liability. If Ryan had to access that money today, the IRS would take their share. At a 22% effective rate, Ryan's real after-tax wealth is closer to $38,200. Daniel's $35,000 has no asterisk, no footnote, no future bill. Every penny of that $35,000 belongs to Daniel. Let's jump to year 10. Ryan's 401k with $700 a month for 10 years at 7% returns sits at approximately $122,000. Daniel's Roth IRA with $500 a month for 10 years sits at approximately $87,000. Ryan is ahead by $35,000 on paper. After taxes at 22%, Ryan's real number is about $95,000. Daniel's real number is $87,000. The actual gap between them is $8,000. Almost the entire difference is the employer match. Strip the match out of Ryan's account and they are essentially tied. 10 years in?
Now let's talk about what happens when careers move. Ryan gets promoted at 35. His income jumps to $95,000. He gets promoted again at 41. Now he's at $120,000. By his early 50s, Ryan is earning $155,000 a year. His career went the way it was supposed to. He worked hard, he got rewarded, and his 401k kept growing the entire time. More contributions, higher balances, more compounding. But here's what Ryan never mapped out. Every dollar sitting in his 401k will be taxed at whatever rate applies when he takes it out. Not the rate that applied when he put it in. Not the rate he planned for at 27. The rate that exists in the year he withdraws. Ryan has been deferring taxes for 3 decades. He has been pushing his tax bill into the future. And that future is now approaching. At 65, Ryan's 401k balance is approximately $1,580,000. That number feels extraordinary. He earned it, he saved it, he watched it compound. But it comes with a condition. Every dollar Ryan withdraws gets taxed as ordinary income. If Ryan withdraws $85,000 a year to live on, the IRS treats that as a paycheck. After the standard deduction, his taxable income is around $68,400. At current rates, his federal tax bill is roughly $9,800 per year, every year, for as long as he lives.
And then, at age 73, Ryan doesn't get to choose anymore. Required minimum distributions kick in. The IRS requires Ryan to withdraw a minimum amount every year based on his account balance and life expectancy. If Ryan's 401k has grown to $2.1 million by age 73, his first required distribution is approximately $79,000. He doesn't need $79,000. He was living comfortably on less. But the government isn't asking. That $79,000 gets added to any other income he has. It potentially pushes him into a higher bracket. It can trigger taxes on up to 85% of his Social Security benefits. It can increase his Medicare premiums. Ryan did everything right for 38 years, and now he's being forced to take money out of his own account, whether he wants it or not. And if tax rates have gone up between now and then, which given the national debt trajectory is more likely than not, every single one of those forced withdrawals costs more than Ryan ever planned. That is the bet coming due. Daniel at 65 has a different situation entirely. His Roth IRA balance is approximately $1,060,000. No employer match for 38 years means a lower gross number than Ryan. But here's the difference. Every dollar of that $1,060,000 is Daniel's. Not $1,060,000 minus whatever tax rate exists in 2063. Not $1,060,000 minus RMD penalties. $1,060,000. His. Clean done. When Daniel withdraws $85,000 a year, his federal tax bill is zero. His take-home is $85,000. Not $85,000 minus $9,800. $85,000.
Daniel has no required minimum distributions, ever. If Daniel doesn't need to touch his Roth IRA at 73, he doesn't have to. It keeps growing, tax-free, for as long as he lives. And if he wants to pass it to his kids, they inherit it completely tax-free. They'll need to withdraw it within 10 years under current rules, but they won't owe a dollar of income tax on any of it. Ryan's kids inherit a 401k. They owe income tax on every dollar they take out. Same inheritance, very different outcome. Let's look at the retirement scoreboard honestly. Ryan's gross 401k balance, approximately $1,580,000. Ryan's after-tax value at a blended 22% effective withdrawal rate, approximately $1,232,000. Daniel's Roth IRA balance, approximately $1,060,000. Daniel's after-tax value, $1,060,000. Every penny. Ryan's advantage on paper, $520,000. Ryan's actual after-tax advantage, $172,000. And almost all of that $172,000 came from 38 years of employer match contributions. Without the employer match, the Roth IRA comes out ahead. Here's where the full picture comes together. The real answer isn't Roth or 401k. The real answer is both, in the right order. Step 1. Contribute to your 401k up to the full employer match. This is not optional. Free money with a guaranteed return is the highest value move in personal finance. Nothing else is close. Step 2. Max out your Roth IRA. $7,000 a year. You are young.
you are probably in one of the lowest tax brackets you will ever be in. Every dollar that grows tax-free for 30 years is a dollar that is entirely yours, regardless of what Congress decides to do. Lock in the known rate. Walk away from the bet. Step 3, if you have more to save after maxing the Roth, go back to your 401k.
Ryan and Daniel both sat down at 27 and made a choice. Ryan saw the tax break today and felt like he was hacking the system. Daniel saw a future he couldn't predict and decided he didn't want to bet his retirement on it. Neither of them was completely wrong, but only one of them understood what he was actually choosing. Ryan chose to pay the IRS later, at a rate that doesn't exist yet in a country carrying $36 trillion in debt. Daniel chose to pay the IRS now, at a rate he could see in the lowest tax environment in generations, and then never think about it again. The 401k is not a trap. The Roth IRA is not automatically the answer. The trap is making either choice without understanding the bet embedded inside it. The trap is looking at the bigger balance on a statement and assuming that number belongs to you. The trap is planning for a tax rate that the government hasn't agreed to honor. Do you want to pay the IRS when you know the rate or when they set it? Because that is the only decision that actually matters. And in a country with $36 trillion in debt, that question deserves a real answer.